Morning, everyone. Our next speaker, Praveen Kumar, joins us from Baillie Gifford in Edinburgh, where he runs Baillie Gifford Shin Nippon, a small cap growth portfolio focused on Japanese equities. Shin Nippon means New Japan, and the trust pursues a strategy which reflects that, with a high conviction stock picking approach, aiming to identify companies which can disrupt the incumbents and hold them for the long term. Praveen has managed the fund since December 2015, and under his stewardship, the trust has delivered strong absolute and relative returns. In NAV terms, it's up 100% or just over 100% over 5 years, ranking first in the Japanese smaller company sector and beating all but one of its peers in the broader AIC Japan sector. This strong performance has seen a lot of demand for the trust shares, and it's been issuing a lot of them this year. But past performance is not a reliable guide to the future, we are told, so we must ignore it. Instead, I'll hand you over to Praveen to find out what he thinks the future holds for Japan and for his strategy. Before I do, I want to remind you that your microphones are muted, but you can ask questions by using the Q&A function, which you should be able to see at the bottom of your screen. So please do make use of that function. I'll hand you over to Praveen.
Thank you very much, Pascal. Hello and good morning, everyone. My name is Praveen Kumar, and I am the manager of Baillie Gifford Shin Nippon. In today's presentation, I'll try and cover a few broad areas, starting with the Baillie Gifford Japanese team. We'll talk a bit about our investment philosophy and process, and then talk a bit about what we're seeing in terms of changes happening within the small cap space and the broader economy in Japan, before rounding it off with a brief overview of how we think about ESG, not just in the context of small cap investing in Japan, but more broadly. And then concluding it with a quick update on portfolio positioning and where we're finding new ideas for the trust. So starting with the team. So the Baillie Gifford Japanese team is probably one of the larger teams focused only on Japan within continental Europe. We have a rich and deep level of experience of people who've been covering Japan for many years. And again, in terms of the backgrounds of people that make up the Japanese team, it's quite different and varied. So we have diversity of thought, which we think is quite important to be able to have a very healthy level of debate. But underlying all of that, as with Baillie Gifford in general, we don't tend to have a star fund manager culture. It's very much a team-based approach, which means that there is a constant exchange of ideas. There is quite robust debate within the team, so it's very much a team-based approach. And ultimately, we see ourselves as being simple analysts. So what that means is every single member of the Japanese team, their job is to research companies, write reports, and make recommendations. So it's a pretty flat hierarchy, I would say. Along with the people that you see in the slide, we also have two researchers based in Tokyo. So these are a couple of people who do specific work for us in terms of whether it's company-specific research or whether it's trying to find out what's happening within the regulatory environment in certain sectors. So their remit is quite wide-ranging, and in many ways, they are our eyes and ears on the ground. We do not have any other office, a research office, apart from Edinburgh and a small office in China. And we believe that that sort of structure, which has endured ever since we started Japanese equities, really, is quite critical for us, because staying away from the noise helps us take a step back and think about things from a much broader perspective, rather than getting caught up in the deluge of data that you tend to see on a daily basis, really. So that's sort of a broad overview of the team. In terms of our philosophy, this is pretty much underpinned by three key sort of aspects. The first one being, we are genuinely long-term. When we say long-term, we're genuinely long-term. We see our job as being owners of companies and not just speculators. So in that sense, we tend to be quite supportive of management, especially during the tough times that inevitably companies come across. And this is quite important, especially in the small cap space, because a lot of the companies that we invest in, they tend to be quite immature. So you need to give management the time and space to grow their business, to get their business models to a stage where it can become a self-sustaining, profit-generating machine, and be supportive throughout this transition phase, really. And again, within small caps, as most of you probably know, things can be very volatile. Um, and what that means is we have to be quite careful not to kind of confuse volatility with, change in the fundamental aspects of the business. So ultimately, we are bottom-up fundamental stock pickers. For us, what matters most are the individual company characteristics. We don't tend to pay too much attention to what's happening in broader economy, or what's happening in the broader macro environment. We tend to pick stocks that we believe over long periods of time, and we define a long period as being 5 to 10 years at least. So we pick stocks that have the ability to grow through that period, irrespective of what happens in the broader economy. So in that sense, we try and turn time and volatility into an advantage. Again, our process is very much stock driven. We are not beholden to any kind of sector classifications. We try and cast our net as wide as possible. But as I will discuss in terms of the types of companies that we like, what that means is we naturally tend to apply certain filters. So these are mental filters rather than just using a screen or a spreadsheet. And this is very much a conviction-led investment approach. The third aspect is in terms of embracing asymmetry. And I think this is quite an important underlying philosophy of ours. So what we're looking for are companies that have the ability to generate really outsized returns for clients. And there is a very simple thinking behind this. We believe that if we pick even a handful of these types of companies that generate some really significant upside over long periods of time, then the kind of upside that they generate would more than make up for the stocks that don't work out. And given the high failure rate within the small cap space in particular, there will be quite a few stocks that don't perform as per our expectations. But if we have just a few of these big winners, and more importantly, hold on to them over time, we believe we can generate some really attractive long-term returns for shareholders. In terms of what types of companies we're looking for, again, I will give you a few examples to give you a better feel for it. We're looking for, in the small cap space, genuinely fast growing disruptive businesses that are run by dynamic young entrepreneurs. Now, in Japan, historically, risk taking has been frowned upon. So if you are a startup, it's very difficult for you to get bank funding, for instance. Hiring talent becomes quite difficult because everyone wants to work for the big, well-known names, although that's changing gradually over the years. So it's quite important that you have an element of risk taking in society, because that makes it more dynamic. Now we're changing, though, we're seeing those attitudes change in Japan. We're seeing a lot more startups come to the fore. We're seeing funding environment improve. So all of this is quite positive development, and those are the types of companies that we're looking. And typically we tend to go for companies that are either the leading or have the potential to become the leading player in their chosen area, whether it's domestic or overseas. And again, I can go through a few examples of that. But ultimately, what we're looking for are innovative companies. And as the name of the trust suggests, this is what we believe represents the new Japan. And just going back to the point about being long-term, so the graph on the extreme left shows you the average holding period of a stock in Shin Nippon versus sort of a market average. So we tend to own stocks, 8 times longer than the market, where we consistently say our typical investment horizon tends to be 5 to 10 years, although there are loads of examples where we own stocks for 15, 16 years. on average, at the moment, I would say about 55 to 60% of the stocks in the portfolio have been held for over 5 years. So that is a genuinely a long-term approach. And as I mentioned earlier, we are not beholden to any sector or benchmark classifications, and that naturally means that our overlap with the benchmark tends to be extremely low, which, if you reverse it, would mean that the active share tends to be very, very high. Um, and as you can see in the chart in the middle, the low overlap with index is virtually a permanent feature of Shin Nippon, given our investment style. And the graph on the extreme right shows you the point about focusing on companies that can generate asymmetric returns. Now, this is a graph that shows the absolute 10-year share price performance of the top five and bottom five. And the longest graph, the longest bar there is a company called Monotaro. It is a B2B online retailer of maintenance, repair, and operations equipment. So things like safety helmets, drill bits, anything to do with construction material, etc. And it's been a phenomenal performer. We've owned the stock for almost 14 years. And in that period, the last 10 years at least, the share price has gone up well over 55 times. Similarly, the second name, the Nihon M&A, another stock that we've owned for well over 10 years now. This is an SME M&A advisory business that's focusing on smaller businesses in Japan that have an aging founder. And typically, these companies don't tend to have a successor, or where they do have a successor, these are young people who are not interested in running the family business. So there are an estimated about 5 to 6 million such businesses in Japan, which are at risk of going bankrupt or shutting down simply because there's no one else to run them, and the founders are, well north of 70 years. So this is an absolutely massive market, and Nihon M&A is, the largest player by a country mile. And again, stock over the past 10 years has gone up 40 times or thereabouts. So hopefully this gives you an idea of what I mean when I say asymmetric returns. We're not simply looking for, a doubling or a 5x kind of share price return, but really the kind of outsized returns that a company's a share can generate. That's the sort of stock that we get really excited by. And a final point on that, what these types of returns mean is that even if there are a number of stocks in the portfolio that don't work out, and as you can see, there are a few that haven't worked out, they don't really sort of matter because just the scale of the returns on the upside, on the positive side, is so huge. We think that's a very, very helpful way for patient and long-term shareholders for us to kind of invest in terms of the philosophy. Now, this slide talks a bit about our process. So there are kind of four key questions that and areas that we try and address. But for me, the most important question is the second one. So whenever I look at a company as a potential investment, or indeed whenever I look at a company that is already owned in Shin Nippon, the first question, the most important question that I try and answer is, what problem is this company trying to solve? Now, as with other economies, Japan has its share of structural issues, and given certain cultural quirks, perhaps these issues are exaggerated in Japan. So you could take the example of the energy market, where till it was deregulated about 4 or 5 years ago, there was a virtual oligopoly of large electricity providers who did the transmission and distribution as well. And this meant that customers couldn't really shop around. Now, in the UK, for instance, we take shopping around for the best energy deals as a bit of a given. But unfortunately, in Japan, for the past many decades, consumers have had to forcefully go with their local utility that's tended to have a regional monopoly. So that would be one example of the kind of problem that companies, smaller companies in particular, are trying to solve. Similarly, if you look at the broader distribution network in Japan, whether it's food distribution or drugs distribution, there tends to be a multiple number of players involved. It's not just a simple case of a manufacturer, distributor, and a retailer. There are numerous parties involved. And what that means is it just adds on extra cost for the end customer. And again, we're looking for companies who can bring that system cost down, who can simplify the supply chain, and in the process, build a really attractive business, growing very fast, making very high margins, and also operating a business model that is not capital intensive at all. So just trying to answer this question in terms of what problem the company is trying to solve is a very, very important one for us. Along with that, we also try and think a bit about the growth opportunity. So because we want to hold companies for 5 to 10 years, we need to be pretty sure that the growth opportunity is large enough to sustain pretty rapid growth through that period. And what this means is thinking about any structural trends that might be proving to be a tailwind for a particular industry, or any kind of disruptive technology or a disruptive business model that could challenge incumbents who in Japan tend to be quite slow moving and sleepy. Financial is classic example where you have a whole host of banks that are basically trying to survive. So in many ways, what we are looking for, Shin Nippon, are companies that are looking to grow aggressively and not just trying to survive. And the third point that we look at, and this is perhaps another area where we spend a lot of time on, is in trying to assess the quality of management. So we specifically look for companies where there is extremely high insider ownership, where the founder has a big stake or the family may have a big stake in the business, because we think that's very, very helpful for alignment with minorities. And we also look for management who have a long-term vision for the business, who are aggressive, not afraid of sacrificing short-term profits in order to invest to secure long-term growth. The Japanese market has a peculiar tendency of really punishing stocks or companies that report short-term operating losses, etc., whereas the same thing in the US is actually seen as a positive. So you have these market quirks where companies that are investing aggressively, where the sales are growing really fast, but profits, are not keeping up. Such companies tend to get punished. But for us, that's quite an admirable quality to have, and something that is in short supply in Japan. So along with trying to understand the business model, problem that the company is trying to solve, sizing the growth opportunity, we also spend quite a bit of time speaking with management, not just the top tier, but the middle tier as well, trying to understand the depth of management as well, and try and build a picture in terms of how good or how visionary the management teams are. And finally, we not just look at things in isolation. So our fundamental bottom-up analysis includes thinking about the entire supply chain, as it were, and trying to find out if there are any bottlenecks, if there are any environmental issues, and I'll talk a bit about ESG later in the presentation as well. So it is really quite an in-depth, bottom-up, involved research process, which means that we very, very rarely take decisions in haste, whether on the buy side or indeed on the sell side as well. So hopefully that gives you a kind of an overall idea of the process that we have. Now, talking a bit about the ESG side of things, one thing worth mentioning is the types of companies that we typically go for in Shin Nippon means that invariably they naturally tend to be quite high scoring across various metrics. And the reason I say that is because we typically invest in companies that are capital light, that are solving structural issues, so overall bringing the costs down for the end consumer. And in many ways, they are trying to make Japan a better place for the end consumer, as it were. So the kind of things we look for, along with the alignment, along with things like remuneration for management teams and the metrics that the remuneration targets are linked to. We also look at how they treat their employees, what kind of relationships they have with their suppliers. We focus quite a bit on their pricing strategy. Are they pricing at a reasonable level, or are they trying to gouge their clients? We also engage reasonably heavily in terms of the board structures, so how independent the board is, what's the gender mix of the boards, and that's obviously, as many of you know, still remains a bit of an issue in Japan, where it still tends to be a male-dominated corporate world. So again, in terms of ESG, we don't tend to look at ESG simply as a box-ticking exercise. It is very much integrated into our bottom-up research process. We don't try and treat ESG as a separate area of work. And what this means is that our research, in most cases, tends to be reasonably thorough and all-encompassing. So that is sort of how we think about ESG as being, part of our research process than a separate box-ticking exercise. Now, talking a bit about portfolio positioning. So we have a few sort of different themes that are reflected in the portfolio. And just to caveat here, the reason we show this and the reason we say that these are the themes reflected in the portfolio doesn't mean that these themes drive the stock picking process. If anything, what you see on this slide here is the result of our bottom-up stock picking process. So for us, it doesn't matter which sector a company is in, or what kind of business it does. It's very much down to the individual company's specific attractions. But just to give you an idea of themes that we currently have in the portfolio, as you can see, it's quite varied, cutting across different sectors. So just to pick a few examples, our favorite hunting ground over the past many years has been digital disruptors. And this has always been the largest part of the portfolio. And given our style and preference for the type of stock that we like, this is likely to remain the largest part of the portfolio. Now, within this, what we mean by digital disruptors are essentially companies who are using the power of the internet to challenge incumbents or disrupt markets across different sectors. So this is a bit of a catch-all term. So just to pick out a few examples, Demaikan, the name at the top left there. So this is Japan's leading online food delivery business. So as some of you may be aware, in Japan, food delivery is still pretty much a nascent market. There is a big culture of eating out and going to restaurants. So that has meant that this market is not really developed as quickly or as well as perhaps say in the UK. Now that is changing quite rapidly, and we have a number of players that are coming in. So Demaikan is by far the number one player. Is competing with mainly Uber Eats, which is a subsidiary of Uber. And Demaikan is part of the broader SoftBank group. So it's using an innovative online and mobile model to grow, not just grow the food delivery business, but also try and establish a market leading position. Similarly, GMO Payment Gateway is another stock that we've owned for about 12, 13 years now. So this is Japan's leading online payment gateway provider. And the classic example of the type of stock that we absolutely love, where the one thing that we focus on when we're looking at companies is whenever we think about the growth opportunity, competitive advantage, valuation, etc., we try and not focus too much on the way the company looks today. And the simple reason for that is these are all quite dynamic businesses operating in a rapidly changing industry. So the way a company looks today, it might be completely different compared to what it might look 5 or 10 years down the line. So there is a danger that you create scenarios, etc., based on the current time, which might lead to the wrong conclusions. So GMO Payment Gateway is a classic example. It started off providing simple online payment gateway services for digital payments, but over the years, it's done really successfully, and now it's literally become a bit of a financial conglomerate in the sense that it's branched out of traditional e-commerce and it now provides financial products for short-term financing, for instance, based on the huge amounts of data that it has. It's also branching into some kind of banking related products and services. So really broadening its product offering as it's sort of grown, and that's been rewarded quite well by the market. Bengo 4 is another favorite of mine. So this is Japan's largest digital contracts provider. So this is the DocuSign equivalent of in Japan. And as some of you may have read, in Japan, there is a big push towards broader digitization, especially when it comes to contracts, which has been given a bit of a boost from the pandemic. And Bengo 4 is, right in the middle of this kind of change, and it's growing its sales, doubling every year for the past few years. So again, another example of what we call as digital disruptors. Similarly, it's not all about online. We run a portfolio of 40 to 80 stocks, so there is quite a bit of diversification. Another example would be innovative healthcare. So again, companies like M3, which again we've owned for about 15 years now. It's an online drug marketing platform, so trying to reduce the overall healthcare costs by eliminating really expensive layers of medical representatives. Again, another theme we have in the portfolio, changing employment, an area that I personally think could be quite exciting. As you know, just because we're not reading about it in the popular press doesn't mean the labor shortage problem in Japan has gone away. In fact, if anything, it's getting worse. So Technopro is Japan's largest IT staffing company, which sort of plays to that theme. Similarly, CrowdWorks in Japan, there is a growing acceptance, and there have been some regulatory changes made to allow people to do more than one job. So you can have a regular job and do and moonlight with a side job. And CrowdWorks is a company that actually provides a platform to do that. It's one of Japan's largest such platforms. So again, the labor market, changing nature of employment is probably another area where we could see some exciting opportunities in Japan. So moving on to portfolio holdings. So this gives you a snapshot of the stocks owned in the portfolio. I suppose the key point worth making here is just in terms of reiterating our long-term investment philosophy. So as you can see in the slide here, over half of the portfolio, in fact, almost 60% of the portfolio is held in stocks which we've owned for over 5 years. So there is, a genuine long-term investment philosophy underlying Shin Nippon. And again, we are happy to hold a tail of stock simply because of the point I mentioned earlier, where a lot of these businesses tend to be immature. So, we take an initial holding, be supportive of management, and then hope some of these really smaller holdings end up becoming the M3s or the GMO payment gateways of tomorrow. So you do need to, it's quite important you have that kind of a tail of smaller holdings in your portfolio. So that really is the structure of the fund as it looks currently. And a slide on performance. So just to highlight that, you can do really high growth investing in Japan. People still tend to have this outdated perception, at least in my view, that Japan is all about value or stocks to do with currency, etc. But the evidence is there that if you pick the right sort of companies, and small caps provide a very, very rich hunting ground. If you pick the right kind of companies within the small cap space, and more importantly, stick with them, you can generate some pretty spectacular returns for shareholders over long periods of time. And yes, there will be volatility, and growth is never linear, but that, as I said, is part of what we're trying to do here. We don't worry about volatility. If anything, we see that as something that is our friend in many ways. So just to highlight that you can be a high growth investor in Japan, and if anything, Japan probably presents a much more fertile ground than most markets, simply because not a lot of people have heard about these companies. And funnily enough, a lot of the domestic institutions themselves haven't even heard of a lot of these companies. So there is a clear and massive information vacuum. And for someone like us who's, willing to be patient, go out to Japan and meet these companies. Obviously, we've not been able to do that in the last couple of years, but things are changing, and quarantine requirements have been lifted from say 10 days to 3 days. So hopefully we can resume travel early next year. So for someone like us who's willing to put in that legwork, and if you pick the right kind of stocks, the rewards can be absolutely amazing for shareholders over the long run. Um, so, so yeah, fine. Just last couple of things. So just again, reiterating the point about asymmetric returns. Again, Monotaro has been a star stock, and you can see that if you pick even a handful of these kind of big winners and stick with them, most importantly, you can generate some serious upside for long-term shareholders, and that ultimately remains our goal, and all our efforts are geared towards finding these types of exceptional long-term winners. So that was all I was going to say, and I'd be happy to take any questions that you may have. Thank you for listening.
Thank you, Praveen. We've got quite a lot of questions, so I will rattle through them. There's quite a few people have asked about recent performance in the last year, because obviously that is somewhat weaker than it has been over the long term. So starting with the first one and the first kind of couple melded together. What's driven the 5-year strength? And is it like one or two stocks within the portfolio, or is it a broad contribution from a variety of stocks? And that links to another question, which is about this asymmetry of returns thing that you guys have got going on. So first question, what's driven the performance? Is it concentrated on just a few? Second part of that question, is there a risk that by focusing on this asymmetry of returns angle, that if you don't get lucky and you don't have those home runs, you end up with a sort of, a weaker or a more mediocre performance?
Sure. So shall I take kind of this dispersion of returns question first? Yeah.
Yeah, please. Yeah.
Yeah, sure. So if you look at kind of over a long period of time, we have had some really big winners. I mean, you can see on this chart here, Monotaro going up 55 odd times in 10 years. So given our style, as I mentioned in my presentation, there will inevitably be a few stocks that end up contributing massively to the overall outperformance. But having said that, if you look at the dispersion of returns, you you can almost see kind of three different categories of companies that have contributed to positive returns. So the first category would be the likes of your Monotaro or Nihon M&A that have generated just spectacular outsized returns. So they would be among the top contributors. Then below that, you would have companies that would have contributed to positive returns, maybe not to that extreme level, but maybe gone a 5-fold or 10-fold. Again, not a bad outcome at all. But in the overall context of the returns profile, you would probably see them bringing up kind of the middle part. And then you have the lower tier of the returns distribution, where you have companies that maybe done a little bit better than the benchmark. So again, we don't really tend to focus too much on where the upside is coming from. I mean, given our style of trying to spend all our energies to unearth some of these big winners, we inevitably will have a few of these stocks driving the overall returns of the portfolio. And in terms of the other question, where that we've been a bit lucky with these stocks, and what happens if we don't get a home run. I suppose one thing I would highlight is obviously Shin Nippon has been going on since 1985, and the philosophy is more or less remained consistent. We've had big winners through all the period that Shin Nippon's been in existence. So I don't know who said this quote, but it was something on the lines of, if you do something a few times and it works, then probably you're lucky. But if you're doing it for a very extended period of time, probably, there is, yes, there will be an element of luck, but probably there's a bit of skill there as well. So I would like to think that, given our style and a very, very long-term track record, our unwavering philosophy, and just the institutional makeup of Baillie Gifford, which is pretty much geared to this sort of thinking about, which are going to be, the big companies that are driving change across sectors over the next 10 years, 20 years. Just thinking a bit more unconventionally, I think probably gives us a little bit of skill, I would like to think, in terms of being able to spot these big winners. So yeah, I wouldn't be particularly concerned that the hit rate of these kind of stocks, we don't think on those terms. It's pretty much based on the fundamentals of the companies, and as long as we get that right, as long as our process is consistent and we're not chopping and changing stuff, I would imagine that we should be able to do well in the long run.
Just final question on that same issue is in the last 12 months, has there been a big disconnect between any of the, in terms of the holdings that you've got in the portfolio? Have some of them disappointed in terms of the performance versus their fundamentals, as in should they have performed better but they haven't? And if so, can you talk about them, and also have any of them actually disappointed in real terms because they've, it's not just the performance that's not made the standard, but the underlying company has, it's not just the share price, it's the company itself has struggled.
Sure. So the first point I would make is for us, we tend to look at least 3 to 5 years as a sensible period of looking at performance. We're not worried if we underperform for a year or a couple of years because we know what our process and philosophy is. It has, worked over long periods of time. We've not changed anything. So on that front, I'm not too concerned about what's happened in the last 12 months. And if actually you sort of dig into what's going on in the portfolio during the pandemic, obviously a lot of these internet businesses did exceptionally well. In fact, in some cases, I would go as far as saying that the share prices are actually run up too far ahead of the fundamentals. The market got excited with all these digital sort of businesses. So there was an element of that last year. And what we've seen sort of in the last kind of 12 months, really back end of 2020 and all through 2021, is in many cases a bit of a reversion to the mean, for want of a better phrase. So basically, people have started, getting a bit more excited about these kind of reopening plays or, whatnot, and, companies that might benefit when things start to get back to normality. And that has resulted in, a pretty hard rotation away from these kind of high growth stocks into some really sort of, questionable names. So just to highlight, so far this year, the best performing stock in the benchmark that we use, that's the MSCI Japan Small Cap Index, the best performing stock has been a shipping stock, Mitsui OSK. Obviously, that's not a company that for Shin Nippon I would go anywhere near, but obviously it's done phenomenally well in share price terms. So that's a classic example of the type of businesses that people are preferring now. Now, when you look at the fundamentals of the stocks that we own, if anything, they've actually improved through the pandemic because the market development has accelerated. So the example of the food delivery that I gave you, so people are becoming more and more familiar with this sort of concept in Japan, which, to be fair, was a bit alien to them even kind of 5 to 7 years ago. So the fundamentals have actually improved. But if you look at the share price, you would think that it's been a bit of a disaster, and that's totally not the case. It's simply that a lot of these names had a pretty phenomenal 2020. People are just taking profits and looking at some of these other kind of trends that they usually tend to do, reopening plays or tourism stocks or whatnot. So that really is what has happened. And personally, I remain fairly comfortable in terms of the investment case of the holdings that we have.
Thank you. There have been a few questions about the unlisted element of the portfolio. Can you talk to us about, well, I guess the questions are, what expertise have you got at your disposal because obviously it's a very different thing to a listed company. And what kind of process do you have in place to ensure that the things that make it into the portfolio are rigidly brought in and are processed properly, so that the right questions are asked and the right record of those questions or the answers is kept? And also, how big an element of the portfolio would you see this becoming in the future? Because obviously other Baillie Gifford trusts, Scottish Mortgage, the famous one, has kind of got quite a few unlisted holdings now. This is a trend we're seeing. Is this something you'll see more of in Shin Nippon?
Sure. So just starting with in terms of the infrastructure that we have at Baillie Gifford that helps us to do unlisted investing. I would say over the years, we've built internally quite a reasonable kind of sophisticated infrastructure. So whether it's on the investment research side, whether it's on the legal due diligence side, and obviously Scottish Mortgage has been a bit of a pioneer in this, being, having invested in Alibaba when it was private, and all of you would have heard those anecdotes. But over the years, we've massively beefed up, both in terms of expertise, in terms of staff, in terms of some software tools, etc., to allow us to invest in unlisted companies. And now I would go as far as saying we're probably at a stage where it's no different to investing in public equities, honestly speaking. So internally, our legal team, we've got a very, very extremely competent legal team who have basically done so many deals now that it's become second nature. There's a dedicated team for the unlisted companies. We have a dedicated team, a separate team that looks at valuation. Again, we use a number of sources. We use a third party. We use our internal kind of valuation methodologies. So we have a separate team that looks at valuation. And again, we have a dedicated private companies team, which runs the Schiehallion Investment Trust as well. So there is quite a high degree of expertise and experience that's been built up over the years. Now, the situation in Japan is slightly different because I only started looking at unlisted companies in Japan about 5 odd years ago. And so far, I only have 3 companies to show for it. And the reasons for that are less to do with the mechanics or the process of actually investing and due diligence, etc., but simply to do with the market structure in Japan. So the unlisted markets in Japan is still very, very underdeveloped. It's a fraction. If you look at the amount of venture capital funding in Japan versus in the US, Japan is probably to be something like not even a tenth. So it's really, really tiny. And also, a lot of the unlisted companies in Japan tend to be very small, even for a small cap specialist like myself. They tend to be quite small. And the slightly bigger ones, if you do find them, the amount of money that they raise tends to be quite small ticket sizes. So really, for us, it wouldn't make economic sense to invest such tiny amounts. So that's been the situation. And also, we've not really had a kind of an information network on the ground. So some like, James or Peter Singlehurst, who runs Schiehallion, they would probably be getting 15 to 20 emails a day with ideas and leads. Sadly, that's not the case in Japan. So I have had to set up my own network of, a few experts, a few industry insiders. And maybe in the last 2 or 3 years, I've seen a real change within unlisted. So getting a lot more ideas through a lot of brokers and now doing unlisted. They set up special teams for unlisted. So I think in 5 years' time, so at the moment, unlisteds make up only about 2 to 3% of the portfolio, just the 3 stocks. In 5 years' time, I would expect that number to be more, definitely higher. We have authorization from the board to go as much as 10% of the fund in unlisted. I don't think we will be hitting that anytime soon, but certainly, in the next 5 years, I would at least, be pretty confident that we'll see a lot more names in Shin Nippon.
Interesting stuff. Question that has come in that's quite linked to what you've just been talking about, really, and quite a simple one, I think, is how affected have you been by the inability to travel? in the last year or so and go and see these people, face to face and understand exactly how things work. And obviously, even more so in private companies, that's a question of, you can't get the stuff out of the printed material or whatever. You got to actually meet these people. So how's that work?
Yes. So, I mean, in terms of access to companies and research, I mean, we have been, as you can imagine, it's mainly been through Zoom and online video calling, etc. So that's been going on at a steady clip, and we've not really felt hamstrung by the ability or by the inability to travel to Japan. And in fact, an interesting anecdote, we made our third unlisted investment for Shin Nippon during the pandemic, just through online calls. So this was a company called Spiber, which is a synthetic biology company, and it's developed at a commercial scale technology to make synthetic cashmere and a number of synthetic materials. So again, very, very strong ESG credentials. Cashmere is one of the most kind of environmentally damaging materials. So they basically researched, spider silk, how spiders actually make silk. They've got a database, they've gone down to the level of genetics and modified some organisms, given them the ability to actually make the stuff. So you basically got a factory of microorganisms producing the stuff at scale, and they basically take it out the other end. So all of that, we had a chat, numerous chats with management online, with different scientists, R&D people, etc. We even got a professor of synthetic biology from the University of Edinburgh to actually have a chat with them, to actually see whether there is anything interesting, or is it just a whole lot of guff. So a lot of different sources we've used, and ultimately we decided this could potentially be quite an exceptional global business if it works, and we decided to invest. So we have been able to kind of keep going, but yeah, it's not 100% ideal. But the good news is, as I mentioned at the beginning, the Japanese government is relaxing requirements for business travel. So they've brought down the number of days that you have to quarantine from 10 to 3. And there's quite intense lobbying going on within Japan, within Japan's business community, to completely remove quarantine requirements for business travel. So I am very, very hopeful that by at least first quarter next year, we should see business travel resume in Japan, hopefully.
Yeah, awesome. We have no time left, but I really want to ask you one final question, so I will. I'll get told off by Marisa. Basically, what are the implications in your view of rising interest rates in the US? Japan is a big exporter. What, from your portfolio's point of view, is this a changed environment, and what are you going to have to do to cope with it?
Yeah, I mean, from our perspective, again, this goes back to the points I made about focusing more on individual companies' attractions. And part of that analysis also looks at things like pricing power and, input costs and things. So just looking at the overall cost structure. And typically, because of the types of businesses that we go for, these usually tend to be quite capital-light businesses. Mostly quite sort of online services kind of companies, and companies, even when they're not online, if it's, let's say, if it's a brand, or if it's sort of some kind of consumer good, we typically go for the ones that have a very, very strong competitive position, really high market share. So that means that it gives them a degree of pricing power. So just to give you an example, we own a chemicals company. Interestingly, now you might think, how can a chemicals company be a rapid growth business? So this company actually makes the building blocks, the base oils, as they're called, that go into making the refrigerants for air conditioners within cars and homes, etc. And the base oil that it makes gives rise to refrigerants that are among the world's least polluting. So refrigerants and air conditioners emit, a lot of greenhouse gases. So the stuff that this company makes, it has the lowest kind of impact, and they're looking at getting that to zero at some point with the next iteration. And that company, recently they raised prices by 20%. simply because they are one of two suppliers in the world of this particular raw material. There's another German competitor that does the same thing. So I think with interest rates and all these things, I mean, it's quite easy to get caught up in all the macro stuff. But I mean, for us, as I said, we believe that these are the companies that have the ability to grow at pretty fast rates, make pretty attractive margins, irrespective of what happens. And obviously, we're talking of a very long-term horizon here, 5 to 10 years. So yeah, I personally remain fairly comfortable with the positioning of stocks in the portfolio in a slightly different interest rate environment as well.
Brilliant stuff. Thank you very much, Praveen. We don't have any more time, I'm afraid, guys, and there are some questions outstanding. We will pass those on to Praveen in an email, and he will, I'm sure, take the time to have a look at them, and we'll provide the answers to you from our end once we've got them. In the meantime, thank you all for joining us. Polar Cap Global Financial starts in 10 minutes, so I better hurry. If you haven't registered for it already, you can just look at our homepage and you'll be able to access it that way. And all that remains to say is thank you again to Praveen, and thank you for a fascinating presentation. See you later.
Thank you. Cheers. Bye.
Bye.